Let's get started. Hello everyone. Thank you for joining today's session. As part of our wider wellbeing programme, we're delighted to be piloting today's Money Smart workshop for you. I'm pleased to introduce Hannah and Darren from Finsbury Associates, who will be hosting today's session. Just some housekeeping before we start. Please do stay on mute throughout the presentation, but we do have some time for Q&A at the end. So please use that opportunity to ask as many questions as you may have. We will be recording today's session, so obviously do bear that in mind when you are asking questions. And finally, we will be asking for your feedback following today's session. I will now hand you over to Hannah.
Thank you. Yeah, as there's a Q&A box, so if you want to ask any questions as it goes along, as it comes to your mind, then drop it in there, and I'll try and answer them. As the session itself, is probably about half an hour. I'm going to talk through all the things that I feel that people need to know whilst living here in the UAE around finances and essentially family safeguarding. It's the Money Smart workshop. I'm just going to share my screen, so just bear with me. Okay, so. Okay, so firstly, for everyone that doesn't know who Finsbury Associates are, Finsbury Associates, we're a boutique wealth management firm here in the UAE. We've got Finsbury UK as well, and we're actually just in the process of getting DFSA license as well, Cat 4 license. We are essentially financial advisors, but we're all UK qualified or equivalent, and we have 135 million under management. Probably, if you haven't heard of us, the reason you haven't heard of us is because we're not one of those annoying people that give you a cold call. We have never cold call, and the way that we speak to our audience is really through the likes of webinar and word of mouth and referrals. Myself, so I'm the managing director of Finsbury Associates. I'm ex-Barclays Private Bank and really focused more on the taxation side as my specialism, but I'm a chartered financial planner. The 3 stages that I'm going to talk you through over the course of this webinar is emergency cash and paying off debt, and probably giving you a few tips around things like credit cards. Stage 2 of planning is making sure that you've got the right documents and insurances in place. So it's all about family safeguarding, or actually making sure, even if you don't have a family, that you are safeguarded yourself. And then stage 3, which people get a little bit more excited about, is around how do I start investing my money? What should I invest it in? How do I make it tax efficient? So I'm going to come on to that as well. Okay, so the stage 1 of planning. So look, this is a study that HSBC did. They found that 80% of expats leave Dubai with the same or less money than they arrived. I mean, that really is a crazy number when you consider most of us are, not paying tax and earning similar amounts that we were in our home countries, but maybe actually saving, 45%, 47% in tax. And the fact that actually people are actually going home with less. Well, why is that? Well, people do get carried away with the UAE lifestyle, and we know that. But we do need to save. We need to save for all of your objectives, which is, you need to have your emergency fund. And here, unlike, your home country, you need to actually save for retirement. There is the gratuity scheme, but that really won't last, or even if you're in the new DISC scheme, it's not going to be sufficient for your retirement needs because of the amount that's invested into it. Okay, so I usually make this much more interactive because I'm usually in front of people when we're doing this webinar. But it's interesting here in the UAE when you look at what the percentage rate is on the credit card. You go, oh, okay, that's really reasonable. You know, it's only 3.09 or 2.99%. And people think that that's all they're paying on their credit card. But that is actually the compounded amount. So you're looking near on 45% as an interest rate over the course of the year. It's not very clear here in terms of, but credit card debt is obviously the worst kind of debt that you can get yourself into. If you've got credit card debt, the best thing that you need to do is actually go get a personal loan to pay off the credit card and then rip up the credit card. The other thing that people might not be aware of is the local banks here still put something on the credit card called Credit Shield. If any of you are from the UK, or you'll know that there's something called payment protection insurance. There was a whole scandal about it, PPI insurance, people having it on their credit cards, not knowing about it and paying all this money towards it. People got a lot of money back from that. But here in the Middle East, it still surprises me that actually it's still put on your credit card. So just always bear in mind, I actually was with a client last week and told her, and she just hadn't checked her credit cards. And she had been paying this every month, even though she had been paying off her credit card. She'd been paying this insurance, which covers her to cover her balance, but she never had a balance on it. But it's based on what she should, like, her on the monthly amount that she'd been spending. So it's actually quite a lot of money that she had been wasting over the course of the couple of years she's had the credit card. I was asked to put in this recently, given what we've had during COVID around people, you know, losing their jobs or being redundant. So it's just to, and I'll cover it really, really quickly, but I just want to bear in mind that anyone that does get into debt here, there's a lot more help than there used to be. We're not in 2008 where you need to just go, you know, and there was so, you know, you heard the stories of people just leaving their cars at the airport and you know, and fleeing. Really not there anymore. There is help around loan consolidation and debt refinancing. So anyone that, hopefully no one gets in that position, but there is a lot more help around that. Okay, so what do we need to make sure? We need to make sure that you have enough cash reserve. So we recommend that you should have at least 3 months of your monthly expenditure in your bank account as a cash reserve. Before you look at any investing, you should have that 3 months of your monthly outgoings. If you're married and there's 2 of you working, 3 months is usually sufficient. I do say if you're not married and you've only got, or you're the sole earner, really that should increase to 6 months. Difference being, obviously, if it's unlikely, unless you're both in the same company, which I have experienced, that you'll lose your job at the same time or get sick at the same time, and you need to eat into that reserve. But between 3 and 6 months is really where you need to be. In terms of making sure you're also budgeting, so many people will, when we go and see them as clients, we go, well, how much is your current expenditure? And they go, I don't know. I don't know what I spend on a monthly basis. And that's really where you it's a starting point of financial planning. It's, okay, where do I spend my money? You'll be really surprised. I mean, I once pointed out to my husband that he was spending, you know, near on 600 dirhams a month on Costa coffee. I mean, okay, but over the course of the year, that adds up. And so I went and got him one of those, you know, those takeaway coffee cups that you could use on an espresso machine at home. But it was a point that he actually had no idea, because it was just one of those things. He went and tapped every day and got his coffee. So actually being able to track what you're spending money on will be really, really important, because you can see then how you can look to kind of make changes and save over the longer term. We've got an app which is free, so Finsbury Wealth Expat Financial Planning, that you can download for free, and it does have a budgeting tool which is AED specific. If anyone needs one, then they can download that. Okay, stage 2 of planning, that's really around family safeguarding, or even safeguarding yourself. The amount of people that we speak to who haven't got the right documents in place that they need, or the right insurances in place. So we have to again bear in mind, and I don't know what your company policy is, but the statutory policy here, well, I actually think it's even worse in the DIFC. I think it's 10 days full pay in the DIFC. But the statutory sick pay is not very good here in the UAE compared to, you know, I know Barclays in the UK, if I was to get sick, I would have 6 months full pay. Here, it's 10 days full pay. So very, very different. So it's making sure that you have the correct insurances in place to cover you. The other thing is a standard, you know, we might be used to having a death in service. You know, if we pass away, we're going to get 4 times our salary or 10 times our salary. Again, that's not mandatory here. It is, you know, there are some very, very good companies that offer that, which is great, but it's not mandatory. So just making sure that you know what you're entitled to if, God forbid, the worst happens. It's obvious if you don't have insurance and you've got family, if anything happens to you, whether that's sickness or death, you know, you need to replace that amount of money, and it's not expensive. You know, it's like you get your car insurance because it's mandatory. It's kind of the same. You should have some form of insurance, even if you've got a good policy with work. That only covers you whilst you're employed. Well, if you get sick and then you're outside, and you obviously have to give up your job, or you need to go back to your home country, you don't have that anymore. That coverage. So making sure that you have your own personal coverage is really, really important. And then documents. So making sure that you've got the right documents in place. So if you've got children, making sure you've got a guardianship document. The rules around guardianship has changed recently. You might have read it in the newspapers. But essentially, what used to happen is if something happened to my husband, his father would become the guardian of my children and I would be the custodian. Okay, that would have been fine in my scenario. I get on well with my father-in-law, and he would have given me over the children. But more difficult if, you know, if that relationship is not there. It happened to a friend of mine who had to find the father to give the guardianship back to her. Having said that, that part of it has, if you read what you know what's come out in law, that has changed. However, when I've spoken to many lawyers in this area, they're saying that they actually haven't received the details. So it's still important that I think you cover that off in a guardianship document. But more importantly than that, it's making sure we don't tend to have family members here. If something happens to us, who will look after the children temporarily before, you know, my sister-in-law, who is my permanent guardian, manages to get to Dubai to look after my children? Who are my temporary guardians? They need to be someone that's here. And if you haven't got that written down on paper, then unfortunately the state will get involved. Everyone goes, oh, that's shocking, but of course the state are going to get involved. They will get involved in every other country as well. If they didn't know where those children needed to go, they would have to go to the local women's and children's centre. So really, really making sure that you've got a document in place that states where those children should go. We do a civil letter of wishes, which is free of charge. It's essentially a private declaration. So it's if you want to have it attested, or you want to have a DIFC one, that needs to be done through the courts. But as a first instance, just having something on paper, which is your private declaration of where your children need to go in an emergency, should suffice. We call it an in case of emergency plan, ICE planning. Wills. So again, we get asked the question a lot, should I have a will? Do I need a will? And again, given what's happened recently in the news, it seems that you would only need a will here if you have UAE property. But essentially, to give you an example, we're under Sharia law. If I, I'm married, got 2 children. If my husband was to pass away, I would just get 1/8. My mother and father-in-law would get 1/6, and then my son and daughter would get the rest. But actually, my son will get more than my daughter, so double what my daughter gets. So it's not really in line with my wishes. And also, my children are under age of 21, so those assets could potentially be frozen until that age. So not how I would want it distributed. So there's 2 ways you can get around that. Well, one, hopefully, given the changes which have hopefully come out recently, which we're waiting to see the actual detail, that they will follow your home country will and distribute the assets unless it was UAE property, which means that UAE property, you will need to get a will. And there's a number of ways you can do it. There's DIFC, belt and braces. Downside of it is cost. You're looking just to get it registered, 10,000 for a single will, 15,000 for a mirror will, and then the lawyer's costs on top. Or you can actually go get it at a low cost will, I would say now, down in Abu Dhabi, where it's 950 dirhams for the registration. So there's ways of doing it, but if you do have a property, it's definitely a necessity. Outside of that, we'll wait and see for the finalization on the new law. But the other thing is, if it's liquid assets, just making sure that you hold it offshore would be my recommendation. Okay, got rid of the depressing things, debt and death and getting sick. Now we talk about where people are a lot more kind of interested, which is, where should I place my money? How do I invest my money? So firstly, a lot of people do hold their money in cash. They like the fact that with cash, they don't see that they can lose money. Okay, so there's no risk with it in their opinion, and people tend to hold a lot more cash than they should for that purpose. As I said, you need to make sure you have an emergency cash balance to look after you if anything you needed it in that period, 3 to 6 months. But after that, cash is the only asset class that I can guarantee you right now you will lose money on. And that's because the rate of inflation is much higher than interest rates. And I can't see that changing anytime soon. I can only see, I think that interest rates will remain low for quite a long time. But even if you look back in history, which is what this is showing you, it shows that the stock market has always kind of performed better over a 5-year and a 10-year period. If we look at this fast forward, it's going to be even higher than that because of the interest rates being where they are at such historically low levels. So when it comes to saving for your retirement, how much do you need to save? Okay, so you should save as much as you can as early as you can, is my answer. So as much as you can save, the earlier, the better it will be, the easier it is for you to meet your goals. If you needed to have $1 million at age 65, and if we took the 5% return here, which to be fair is is a realistic return on a moderate kind of portfolio net of fees, how much do you need to save? Well, if I started when I was 20, I only need to save 59 dirhams a day. Well, that's what a Costa coffee or a couple of Costa coffees are. But every 10 years that you leave it, it doubles how much you need to save. Okay, and if you leave it as long as 55, suddenly you've got to find 774 dirhams a day. Well, that's quite a lot. You might look at this number and go, okay, well, $1 million, that sounds like a lot. Maybe I probably don't need $1 million at age 65. But $1 million will only provide you with $50,000 of income a year, because you can't draw down on the capital in retirement. If you draw down on the capital, each year it will get harder and harder and harder to meet your income. So what you want to do is get to a number where you invest that, and you pull down at, say, a 5% return, and that's your income, and you leave the capital for the next generation. So $1 million, whilst it sounds quite a lot, actually, as I said, will provide 50,000 of income, so not as much. Something that we do with our clients, which I think is really, really useful, is showing how you save, how much you need to save to get to your goals. So a bit of cash flow modeling. I won't go through all of it in details, but essentially, this is an example. Hayden, that's my son, but he wants to go to university in India when he's 18. So he's got 16 more years to go. The cost of the course over the 4 years is 65,600, and but we've got to inflate that, which is 174,000. So when you look at that and you go, oh, in 18 years time, I've got to find 174,000, it does sound like quite a lot, but how much do you need to save to get to that? Well, actually, I only need to save $423 a month. And if that grew by 5%, in 16 years time, I will have the 174,000 to pay for the university. I'm hoping he goes to India rather than he goes to the UK, because in the UK, 1 year of education is 62,000, which means that in 16 years time, when you inflate that number for a 4-year course, suddenly I need to find 663,000. Okay, break it back down. I need to save 1,615 per month at 5% growth rate to meet this goal. So really, really good that you kind of know what your goals are. What do you want to pay for? Do you want to pay for your children's education? And work it backwards, okay, and plan for that. And we do the same for retirement with our clients. So how much do they need to save to meet your retirement goal? Okay, how much have you got already? How much are you saving already towards your retirement? What assets do you have to draw down at in retirement? And then how much you need to move forward save. So this is an example of one of our clients, age 65, wants to retire at age 65, current age is 40, so he's got 25 years. When you break it down into paychecks, that's only 300 paychecks that he has to meet that goal. So suddenly, when you say it like that, it doesn't seem as much. He wants $3,000 per month. Okay, so that's in today's money. In 25 years' time, $3,000 is not going to be worth $3,000. So we have to inflate it. We use an inflation rate of 3%. So in order to get the equivalent of $3,000 per month in retirement, he would need a portfolio that would be providing him $6,281 per month. Okay. We know that he's going to rent out a property at age 65, which he thinks will bring in about $500 a month at that time. And he's currently got a portfolio of 100,000, which we assume will continue to grow at 5%, and he plans to draw down at 5%. So that part of the portfolio of what he's already got will give him 1,910. He's also putting into his pension or his retirement plan $1,000 every month. Okay, so then we work out, okay, well, what's the lump sum needed at retirement? So he needs a lump sum retirement of 1 million. He needs to save $1,761 to meet his goal. He's saving one already, so he actually now needs to save $761 to meet his goal. So what we do is we work out, every time we sit down with our clients, we continually update this to see where they are. Are they on track to meet? Are you on track to meet your goals? Have you sat down and actually worked out what you need to do to get to your retirement goal, or even what that retirement goal looks like? It's really, really important that when you're looking at your finances, you know what kind of that end result is. And as I said, it doesn't matter, like this client, if you can't do it all, doesn't matter. The point is you start with what you can, because the amount that you start with will make it easier as you go forward. Okay, and then we talk about asset classes. So we're not stockbrokers. The only way you lose money in the market is if you're forced to sell at the wrong time, or if you don't diversify your portfolio. Okay, so if you don't diversify, you buy in individual stocks. So you go down to the golf course and you hear that Tesla is the place to be, or Bitcoin is the place to be. That's how people do lose money. It's quite how people also make money in the market, but it's also how people lose money. When we talk about saving for retirement or education or objectives, that can't be play money, as I call it. Play money is, you know, money that you don't mind losing, and that part of the portfolio you can put into Tesla or Bitcoin. But when we're talking about meeting your goals, we need to make sure that we kind of get you there without taking significant risk. So how do you do that? You do that through diversification. And I love this slide because it shows you why diversification is key. Of the asset classes, so the 9 different asset classes that you've got, it shows you which ones have performed better each year. So, you know, if you were in 2015, the S&P 500 performed the best and commodities performed the worst. Okay, but in 2018, commodities and gold performed the best, and actually the S&P was kind of there, but a real estate investment trust performed the worst. So the point is, if you build a nice diversified portfolio and you rebalance it over time, that's when you get the most amount of growth in the portfolio. Okay, just another little thing in terms of sending money overseas. I've spoken to so many people where they send money through the banks. And I've also done it myself, where it's gone, oh, you know, I'm sending it from this bank to my bank in the UK, and it says there's no fees going to be applied. And they don't charge the fees, but what they do is they do take a huge spread on the exchange rate. So don't send money through the banks unless you work for a bank and you get spot rate. The best way to do it is through a foreign exchange service. Downside of it, takes an extra day to get to your bank account in your home country, but you will get a much better rate. Finsbury has Finsbury FX, which is powered by GC Partners, but there are a lot of them out there. It's just making sure that you get that additional rate, which over time really makes a difference. To give you a comparison, the banks probably take between 3 and 5% in a spread, whereas a foreign exchange will take 1.5. So especially on larger amounts, it makes huge difference. Okay, and then the last thing that I want to cover off, because it gets forgotten about, and I've got a whole nother seminar on different tax structures. As I said right at the beginning, taxes is probably what I love the most, to my detriment. But it's so important that we focus when we look at investments, making sure that we structure it correctly from a tax perspective. Everyone, you know, is here, they're not paying tax. And so tax gets forgotten about. People, you know, just invest and they don't see the need to kind of worry about taxation when they go, because they don't worry about it when they go home. But actually, it is really important, because when you need, it's harder to restructure something rather than make something tax efficient at the beginning. So there's different structures available for most nationalities, depending on what you're doing. So making sure that you've got tax, the right tax structure before you even look at investing is got to be the priority for most nationalities. Okay, so that kind of, as I said, is about half an hour in terms of the webinar. But I'm happy now to take any questions. I know that we've got We've got one question coming through. How to best structure your investments from a tax perspective, and are there costs to do so? So look, as I said, there's lots of different tax structures available for different nationalities. Each of them does come with a cost. There's usually a structuring cost, but it depends what structure we use. But it's just having those discussions. You may not need a structure, but as long as you've had those discussions to start with, because otherwise you could actually end up having a rather large tax bill that you didn't need when you go home. Is there any other questions from anyone else? So I've done my job really well. Everyone's been trying to ask any questions. We are obviously going to send back some feedback forms, and for those, it is recorded for those of you, for people that weren't able to make the call. And if anyone actually wants to sit down on a one-on-one basis and have a free consultation and go through some of the things that we've discussed today, then obviously that's something that we can arrange. The feedback form will be coming to all the participants, and we'll also have the contact details that can be sent out on the end of this webinar. Okay. Thank you all.
Yeah, thank you everyone for joining. Really appreciate it. As Hannah said, we are recording this, so we will be sending it out. So if there was a lot of information that you wanted to go over again, you can obviously watch the recording. And any questions, please do reach out to us in the meantime. Flora, I don't know if there's anything you wanted to add before we went?
No, just thank you both so much for delivering today's session. And obviously, as we've said, we have recorded it. So hopefully it will be useful for people in the future. But thank you both so much.
Welcome. And Flora, just on the, we do another webinar, which is for UK tax specific, but for anyone that kind of wants to know more about UK tax, which tends to be quite popular around the law firms, happy to set up that webinar as well.
Perfect, thank you. I'll pass that on.
Thanks, Flora.
All right, thank you both so much.
Bye.
Thank you, everyone.
Bye.
Thanks.